Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today I've got a good one for you. We're going to go over the PCE data which just came out this morning, and I was mentioning that it was super important to pay attention to whatever that data was saying because it would constitute the basis upon which the Federal Reserve will make its interest rates decisions next month in June. Of course, it's not the final say. There will be other data points. There will be the CPI data coming out. There could be any number of things which happen, or any number of, just curveballs which come out between now and June 14th to 15th when the Fed makes its decision. But this is the first really good piece of data which the Fed will use in order to, make that call. And right now you can see that there's a lot of green on the charts. We are having an up day in the stock market. And I just want to point out that it's not universally distributed. If you look at what's going on in the charts, not every company is experiencing the same, green spikes. Actually, right now it appears that it's not particularly risk on, and we'll get more to that later. But let's just first cover some of the data that did come out on the PCE report, because, as I had mentioned, I was expecting some type of W pattern to be put on to the stock market charts with the potential for a nice relief rally, potentially coming back down to lows or even making new lows if we get some negative news. I would qualify today's data as pretty neutral, and so I'm not willing to necessarily change my mind about the pattern that we're likely to see on the charts. But of course, we can update this as time goes by. And, so far it's holding up pretty well. So let's see what type of a bounce we can get off of this. First of all, we should mention that, month over month, the PCE data, which is a measure of inflation, uh, actually indicated that inflation is still increasing. Okay, so month over month, they had a 0.2% increase. And this is actually good news because the expectation was 0.3%. And the prior month was 0.9%. Okay, it was almost 1% higher. And so this is actually a substantial decrease from the previous month, and it's better than the expectation. So all in all, that's good news. But in terms of personal spending, and this is the curveball, guys. In terms of personal spending, it was 0.9% up, which is almost 1%, fully up on a monthly basis versus zero point 0.7 expected. So that's not good news. That means whatever the Fed is doing, it's actually not impacting people as much as they would hope, even though systematically inflation is under what they expected. Individually, person to person, we're still feeling the pinch more than what they expected. And of course, the prior month was 1.4%, so that was significantly higher than what they're comfortable with. You can't have things increasing 1.5, 1.4% every single month. That would be insane. And by the way, I would just like to point out that there was a revision since the last report that in the prior month it was a 1.1% increase, and they did a revision which said it's 1.4% now. Okay, so that prior month was 1.4%, and they had originally measured it as 1.1%. So I just want to underscore that these things do rise. Generally, as I said the last time we went over some of this data, generally the government favors the lower numbers the first time that they do the reading with the media. And then, of course, they slowly make little corrections which show that, oh, it's dramatically higher than what they published. So take all of this with a grain of salt. If you're hearing lower numbers, expect that it's probably, about even. If you're hearing high numbers, expect that it's higher than what they're letting you believe. I'm not sure exactly what causes this bias, but it's been consistent through every single administration for basically the history of these type of inflation readings. They always give the best reading possible uh, when they first release it, and then they make little corrections that make it look worse and worse um, as they correct the data or as they get a clearer picture. So, can the good feelings be tempered a little bit as the corrections roll out in June? I think it's possible, but for right now, we can at least say that inflation appears to be starting to be getting under control, even though it's rising higher than what we would like on a personal basis, and it's only basically meeting expectations on a systematic basis. Okay? And expectations does not mean what we want. Expectations means what they thought would happen. Okay? Which is not what they want, right? In terms of year over year, inflation was measured as 6.3%, as opposed to the prior year, which was 6.6%. And so year over year, we also see an improvement, but it's only 0.2%, and pardon me, 0.3%. And again, these things can be corrected, so just assume that's about even, right? The core index was as expected, and so the basic basket was they're basically meeting their expectations of what they laid out. And the reason why that's important is because if they're essentially meeting their expectations, then it suggests that they're not necessarily going to go harder on increasing interest rates than what we've already been led to believe. It suggests that they might just keep it at the levels of increases that they've already projected, which would be 50 basis points. Okay, so the Fed originally came out and they thought that they could increase just by 25 basis points per meeting. And the market took a big hit, right, from like November until January. Bitcoin and crypto and the stock market, all of these things took a pretty big hit. But then they decided that, oh wow, inflation was crazier than what we thought, and so we may need to actually go twice as hard as we thought. And so, in order to fight inflation, they increased it by 50 basis points. And so the market again took a huge hit. It just kept getting, losses after losses on the charts as the markets tried to build in, this new world of higher interest rates and the Fed fighting inflation and also quantitatively tightening as opposed to the previous policies of quantitatively easing, which is just like putting money into the system. And basically 0% interest rates back in 2020 when just they were printing money in an unlimited fashion during the Trump administration. And this is significant because there's still a lot of you know pain. I mean, I guess you could call it pain. There's still a significant amount of liquidity that needs to be dealt with in the market, which has been causing this hyperinflation. And you know, one of the ways to conceptualize this is to understand that, back during the Trump administration, there really wasn't the problem that needed all of this money, okay? There was no reason to inject all of this money into the system. Um, I think if you look back at the data, this was pure politics. This was purely, um, I don't know, billionaires and the politicians deciding that they just wanted to look really good during the middle of COVID. And so they decided to take advantage of the disaster that our nation and the world was going through. And they printed, unlimited money, which then, especially the billionaires, capitalized on. As regular people, they are not really that involved in the stock market, those type of things. They really had no idea what was going on or what to expect. And so regular people suffered tremendously while the super wealthy just benefited tremendously. And then if you happened to be in stocks or you happened to be in crypto during those times, you were a beneficiary of that basically scam against the American people, um, which the Trump administration basically conducted against America. And to be honest, it's basically the biggest criminal, redistribution of wealth in the history of the world. And to put that in perspective, the federal deficit increased from 4.6% of GDP. Listen to these numbers carefully. The federal deficit increased from 4.6% of GDP in 2019, okay, to 15% of GDP in 2020, all right? So that huge gap of more than 10% was the largest, you know, basically robbery. Like 10% of GDP was effectively stolen, right, from the American people. And that was the biggest stimulus since, World War II, and exceeded by a huge margin the, approximately 8%, stimulus which was put in place during the Obama years, during the real recession in 2008, where banks were collapsing, right? We were coming into the end of the deregulation era under Bush, good old W, when he deregulated, all of the banks and all of the financial instruments for the housing, and then the housing crisis, like, unfolded right in the beginning of the Obama administration, and so, that threatened to just collapse the entire world system, where all this crazy, housing debt of people just like flipping houses, sort of the way people flip crypto these days, but like hundreds of thousands of dollars at a time. And we had that financial collapse on the precipice of the world there, and even that was only approximately 8%, right? But during the Trump administration, they did 15%, and there was no real recession at the time. There was no real recession. And so what was that? That was just, again, like the greatest, almost criminal, and people should be in jail for this, People should be in jail for what happened during the Trump administration, where 15% of GDP was stolen in order to basically pump the bags of effectively the billionaire friends of this circle of politicians who took advantage of it. And people don't like to hear this because I think they're in denial, about what happens, behind the scenes. And when people go up in front of cameras and they say, really popular things, or are highly charismatic, it's easy to shrug this stuff off. But we have to be aware of what really happened, and all of that money entered the system, and it was basically excess, pure excess. And that's why you're seeing an uneven, distribution in the reactions of the market, where the risk on assets are taking the biggest hits, in particular, tech and crypto. So if you look at what's happening on the charts right now, you can see this pump is basically on the stock market. But let's go over to Bitcoin and look what Bitcoin's chart looks like. Last week or the week before, people were saying, oh, maybe Bitcoin has decoupled from the stock market because it's performing so well against the stock market. The stock market had this really teeny tiny dip. Remember, I went over this. I made a video that said, no, crypto has not decoupled from the stock market. There was this little teeny tiny dip on the charts in the stock market, a little teeny tiny dip. And people were like, "Oh, Bitcoin's holding up so well." Right? If we draw a little line here, there was a little dip below that line. So that means the stock market is crashing while Bitcoin is just holding its value. Look, Bitcoin didn't have that dip. Look, there's no dip right there. So Bitcoin is outperforming the stock market. I said, no, guys. Bitcoin's just holding this level. If you look at stocks, they basically just held that level. But these influencers and these guys that get in your head, they try to brainwash you about things, right? Oh, Bitcoin's outperforming the stock market. Shut up. All right, give me a break. You guys have to stop letting, yourselves be brainwashed by people online, getting brainwashed by politicians, getting brainwashed by all of these different sources, and just think for yourself. Tiny little dip, basically holding the same levels. But you know what is significantly different? This pump right now compared to Bitcoin. All right, that tiny little wick meant nothing. And you know what? Bitcoin eventually had a wick right here. So effectively the same thing, right? Little wick down, just Bitcoin had it a little bit, later, right? Sometimes there's options expiries, the different, different things going on in a market. And so you can have, wicks that just appear out of nowhere where the bulls and the bears are fighting each other. But what is really significant is that Bitcoin is not reacting to the good news today, almost at all. And that's a problem. Why is that a problem? Because it should look like this. It should look like this. We don't care about this little tiny portion of the wick, okay? Like all the rest of that was the same, okay? Like from here and above, it was the same. Like the 90% above that was the same as Bitcoin. Only the tiny little bit right below it was slightly different than Bitcoin, right? When there was a dip in the market. And that could have been for any reasons. That could have been because of the Walmart news, the Target news. It could have been because of Tesla. It could have been any of the major stocks that had just simply underperformed, just dragged down the average of the stock market temporarily, right? But overall, Bitcoin and the stock market are trading pretty similarly. But the real problem is the stocks are pumping today and Bitcoin is not. And what does that mean? It means the market is not ready to be risk on again. Okay, this is a really bad sign, guys. We should be seeing some type of pump, right? There was a projection that I was suggesting that we could have the potential to have a 20% pump. And I'm not saying that it's not going to happen. It could still happen. If we look at CME, we're still technically up on the day, just really tiny baby up. But this isn't looking good for the pump. We should be seeing something like this. We got the dip that I expected, but we're not getting the pump that I expected. So pay attention to this, this difference between Bitcoin and the stock market. It could be that we're celebrating today that the PCE numbers, that the inflation numbers are better than what we thought. But it could be that the market is still saying it's not good enough. And so are we going to see that retracement, or are we going to see another bull run? I feel skeptical. I think that there may be more work for the Fed to do. Okay, we got good news today. Stocks are pumping. Let's go through stocks. We got up, 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 up. Let's look at some of these tech stocks. Up. Okay, Netflix, not so much. All right, MicroStrategy, up with a little bit of a peakiness to it. Nvidia, good. Apple, ooh, nice. Tesla, pretty good for considering what Tesla's been going through. And Twitter even, right? Twitter, which is, pretty much garbage. It's probably worth half of what is on the board right here, and should by all rights be just crashing down because it's basically, bots and scammers, and just they don't care about the people on Twitter at all. Ask yourself, if you use Twitter, do you have any of the features that you actually want? Can you make like a nice image gallery? Can you edit your post? Even if they could track the edits because you would want to see what changes were made, right? Can you edit, a typo? You can't do anything on on Twitter. Twitter is like one of the worst social media platforms that exist. It's effectively garbage. There's scammers just running amok, and you can't even see anything in your timeline that you want to see. Like they hide most of the people that you're subscribed to, and you get recommended to read like junk posts like continuously from people that you don't even care about. I mean, let Twitter burn, okay? Like let Twitter burn. I have no idea what Elon Musk is doing coming in and trying to buy this. He should have let it just crash to the ground before he attempted to buy it. Um, but hey, we all have our proclivities, and he really loves Twitter, even though it's absolute trash. And to be honest, being set on fire would probably help Twitter, more than what the current management is doing. So any change would be good news. But right now, it looks like Elon's maybe trying to weasel his way out of the Twitter deal. Maybe he realized what a bad deal it is, and that Twitter should be coming, you know, down even more. But we'll see. We'll see. Okay. He also has to take care of Tesla and a few of these other stocks. So, a lot to juggle. I mean, the guy needs to focus and get some of these companies on straight, because we're entering an era where profit and loss really do matter, not promises. Okay. The empty promises era is over. Now you have to deliver. Okay. So maybe it's good that he weasels out of Twitter, and maybe he can focus on Tesla and making Tesla just work incredibly well and revive its reputation. But who knows? I use Twitter, so hey, any improvement would be welcome, you know. And as for the other scandals and stuff, you know, that happens in big business. It's not cool. Like, but at the same time, you can't be judge, jury, and executioner. There's a lot of politics involved, but you know, I just hope everybody plays fairly, right? Okay, you know, as we look through these things, we can also see that the dollar is continuing to come down, and so it might be at a little inflection point right now, but you know, overall, we can say that it's coming down, and you know, hopefully it continues to come down, perhaps to 99, giving some relief to the market, which has been suppressed by the dollar. VIX also continuing to come down, which is good. That's the volatility. We're in kind of a more healthy range here. Would strongly prefer to be in these levels down here between 13 to 20, as opposed to above that. Higher than that does mean volatility, which is unhealthy for the market, and higher than 30 is extremely unhealthy. And we can even add another level here, which let's say above 40, which would be, we can call this like a resetting, okay? If we get above 40, I think that's something that the market really wants to see. They really want to see that chaos just get super extreme in the market, where we can say like whatever price comes down to, you know, above 40, that's kind of like a cleansing moment. And you know, we can see it happen from time to time where we get up into those 40s, and then after that, volatility just continuously drops. Right? We got up above these 40s and then continuously drops for a long time. And so that 40 area is really important to kind of clean out the excess. But as you can see, it's super rare. We don't hit that very often. This is measured in years at the bottom here. And so while we do see it appearing regularly, right? The last one was in 2020. And so we're kind of due for one. There's no guarantee that we'll hit it. Like maybe, you know, maybe we're in this type of area, you know, relative to 2008. And, you know, whether or not we see a peak, I know some guys will be looking for that. Some economists will be looking for that, but it's not necessarily something that we're going to hit as the market tries to front run each other. We now live in an era where information travels so fast that people just front run each other. You know, technology goes so fast that people front run each other. And so maybe the peak was 38. Okay, maybe the peak was 38. But if we do get that number, that volatility over 40, it will be considered like one of those, you know, cleansing moments that economists look for. And, you know, the market will be watching for that. A lot of big players would be watching for that. I think if we got over 40, you know, like a solid 41 or something like that, then the big players would say, okay, it's time to come back into the market. Like we've effectively reset, and I can expect all the volatility to be lower from now on. So if we got like just one of these little spikes like this, right? Or preferably a double spike like this, where the second one is lower, got a lower high to it, then again, like I think we would see just money start to flow back into the market. This is not particularly convincing. This is just extremely unstable. And so there is going to be a little bit of muddiness surrounding the issue of volatility. But let's move on from that because we just may not get over 40. And some guys will just have to make their decisions without that regular, increment. Let's go ahead and take a look at just take a look at Ethereum really quick, see what Ethereum's doing. Oh wow. Okay, so I had made this as kind of a joke. Like I said, Ethereum puts in like a spoon pattern, and I drew these arrows of where I expected Ethereum to go. I drew it when Ethereum was somewhere up here, like 2,500 or something. And I said, oh, I expect, based upon this spoon pattern, I expect Ethereum to, get, like 1,500. We're now approximately 1,700 again. And so we are on our way. This check mark was just where I projected it to go. And so we're here. And it looks like we're doing this same type of pattern right here and right here, where you see we have an initial down and then we curve around and come back. An initial down, curve around and come back. Initial down, curve around and come back. And then put on more negative patterns, right? So is Ethereum going to continue to bleed? Well, if you believe my spoon theory of Ethereum, then yes. Okay? Like the soup is going to pour out of the upside down spoon, and Ethereum is going to continue to bleed. The spoons don't lie, guys. So respect the spoon, right? And Bitcoin, of course, is holding stable, but we're still very much in danger of dropping off the cliff if we don't get that pump. If this industry still decides that it's being risk averse, and we can see that it is risk adverse because money is, going into Bitcoin, then we are going to end up with a situation where Bitcoin's just going to be too weak, to hold the level, and potentially we could, instead of having that 20% pump up, we could potentially have a 20% dump. Nothing is fixed right now, but again, I just mentioned the bear flag is still being printed, and the bear flag has its going down to $22,000 to $23,000. There's other ways to measure this. I know some guys are just looking at, the Stokes. This is Crown's method. I learned this from him. He's looking at the Stokes. The Stokes right now is pointed down. It had this curve in the chart, right? You can see we're kind of maximizing low volatility here, and it curved down suddenly, which isn't a good thing because when you pair that with our volatility also being maxed out at the floor here, and crossing, right, and crossing the moving average, then statistically that suggests that the move will be down, that the 20% move will be down. And what's the 20% move that I keep talking about? It's this right here. We put in some consolidation and then we pump, right? Put in some consolidation and then we pump. Put in some consolidation and then we pump. Consolidation and then pump, right? Consolidation and then pump. So we usually have consolidation and then a pump. Even if we continue down, we usually get that. And this pump, right? It's consolidation and then a pump up, right? You see this drop here and then a pump. There are some dynamics that go into it. And the first dynamic is what I was suggesting several days ago. You see this right here, where we had that 10% drop. that's usually a leading indicator, okay, that the 20% pump or dump will come next. And because previously we didn't have the Stokes pointed down, right? And in fact, if you look at, the CME chart, it's still pointed up. This is why I can't give you a solid prediction, guys, okay? Like, it's just too hard to say. Although CME is pointed up, the 24-hour exchanges are pointed down. So we have mixed data here. The professional exchanges are pointed up, and yet the biggest market, the 24-hour exchanges, are pointed down. So what do we do? What do we say about that? All right. Well, the CME is at a hyper extreme. You can see it just firing off signals, and then the 24-hour is at an extreme and crossing over. So we're just going to have to wait a couple more days, see what happens, and hopefully Bitcoin doesn't fall off the cliff or pump without us. But be very careful because right now it could go either way. And although I was projecting that we would see a pump, and I'm still going to be biased in that direction. And there's a couple reasons why, okay? There's a couple reasons why I'm going to be biased in that direction. One, we have the CME gap at 35,000, okay? It's just very tempting for market makers to fill that gap. Two, we have stocks pumping. And Bitcoin tends to follow the stock market pretty closely. Now, it can have wide exaggerations. If the stock market has pumped, 5%, maybe Bitcoin pumps 10%. If the stock market ends up pumping 10%, maybe Bitcoin pumps that 20% to the upside, right? So Bitcoin can have wide exaggerations, and that's why the chart doesn't look the same as the stock market. It can have wide exaggerations, but usually it follows the stock market. And so, unless everyone is just super sour on Bitcoin right now, unless crypto is just dead, like if this is the death moment for crypto, I don't mean death. I mean because a lot of people use that the wrong way. What I mean is if this is the final nail in the coffin for the bear market to be conclusive, right? Where we just see a drop and bear market is on for crypto and this asset is, persona non grata, or whatever on, in the financial world, then, for the next few months or potentially year, then I would expect to see it follow the stock market. So let's find out, okay? This is weird. We should be seeing more life to Bitcoin. And so I'm going to still expect that there might be some kind of bounce, but I have to tell you right now, it's not looking good. It's not looking good. If you look at our daily, we're probably going to curl down, right? Really borderline. If we get under 28,000, we are going to curl down. Still in the, the bearish control zone. This doesn't look good. Come on. We have plenty of room to have some type of a pullback. See the weekly. Weekly doesn't look good at all. And of course, the monthly looks terrible, right? So guys, I'm not going to go too much longer in this video. I just wanted to get that concept of what's going on the daily here. Even on the 4 hour, we're not looking that great. We look like we have some continuation to the downside. And so, yeah, Bitcoin is just not joining the party. Bitcoin is not joining the party. The billionaires that have their money tied up in all these assets, I think they're really perhaps rotating into stocks right now. The money pool is drying up. We can see that the money pool is drying up because money is just flowing into Bitcoin primarily, right? That's the whole basis of this, spike in Bitcoin dominance. Bitcoin dominance would not be spiking like so crazy right now unless money was just fleeing into Bitcoin from all of the altcoins, which is because the money pool overall is contracting and less and less and less, fewer and fewer people are in the market and they're kind of huddling together around Bitcoin. But that money is kind of scared money. It's not the bravest money, right? It's not the altcoin money. The altcoin money has left or it's leaving, okay? They may have little spikes of hope, but they're all going to get burned. And so now the Bitcoin money, which is the bravest of all because Bitcoin is the most stable, right? Crypto. The Bitcoin money also looks like it's starting to dry up. Let's see what total is. You can see total market cap of crypto. Look, this chart looks much worse than the Bitcoin chart. Look at this. That doesn't bode well. This thing's falling off a cliff already. The total market cap is falling off the cliff already. Let's compare that to Bitcoin really quick. See, Bitcoin just barely holding on to it. The total market cap of crypto, by contrast, already falling off the cliff. So the money pool is extremely tight. Just to hold Bitcoin steady, all of the money has to be flowing out of altcoins into Bitcoin just to hold Bitcoin steady. And they're not finding the power to pump Bitcoin, even though the stock market is pumping, which suggests that money is now fleeing from Bitcoin. So there's a lot of money going into Bitcoin from altcoins, but that money is now also going into stocks because they see stocks as more reliable than Bitcoin. You see what that dynamic that I'm talking about? And so that's what could push Bitcoin eventually off the cliff. And the number that we're looking for is 28,000. So if we breach this line, here, then that will be no bueno for Bitcoin, okay? And most likely, Bitcoin will be going down. And if it goes down, then the levels that we can expect are probably that target of $22,000 to $23,000, which again is this bear flag, and also 20%, right? A 20% move, which is the similar to the pumps and the dumps of 20% that we see regularly whenever the Stokes and the volatility are matched up. Okay, guys, that was your alpha for the day. Stay safe. This isn't over yet. There is a huge debate on whether or not the Fed should take a pause in September, but I suspect that they're going to go forward with increases in interest rates in June, that this is not over. that the billionaires may get their way of a pause perhaps in September, but we have to really watch the data carefully until then. A good day for stocks today. Bitcoin is not joining the celebration. This market is being risk adverse right now. Protect yourself just in case. If you're in some really risky plays or you're still overexposed to the market, just consider protecting yourself a little bit. If you want some bullishness, wait for Bitcoin to get over like 31,000 or over 31,000, let's say 500. And if it can hold above, this area, like sitting on top of it and holding above it, then maybe we can talk about potentially Bitcoin joining the rest of the market in some bullishness. But how it's postured right now, this looks pretty bad. And right now, I would be biased to the downside as long as Bitcoin looks like this. If it can pump back up to the top of its channel and join the stock market, then right, which looks so happy, right? It looks so good right now. Then I would flip to being open-minded to some bullishness that perhaps that 20% volatility pop would happen to the upside. But with the mixed data and this kind of slump that Bitcoin's in, it doesn't look good. Okay, by all rights, it should be popping up right now. Why isn't it? The billionaires aren't believing in this asset, or they want it to die. All right, and so let's see if the rest of the market can help Bitcoin out or not. But take care. All right, guys, that was your offer for the day. Stay safe and happy trading.